Morgan Stanley just say that gold is broken and they've named the metal that will be replacing. Good day everyone, welcome to the video of the day. So gold hit at 5,000 plus per ounce earlier this year when the Iran war started and gold was crushed. Not just a little, gold fell alongside stocks, alongside crypto, alongside everything. The metal that was supposed to protect you sold off when you need the most. Now Morgan Stanley, one of the world's biggest investment bank, has said something that would have been thinkable a year ago. Gold is acting like a risk asset, not a safe haven. And they also name the metal they think that be outperforming it from here. We'll start from what actually the words were. So let me give you the exact words from Morgan Stanley metals and mining strategist Amy Gower speaking on CNBC's Box Europe. He said that gold is really acting like a risk asset and not really like a safe haven. Normally, it would be the diversifier in your portfolio. Gold remained roughly 7.8% down over the last month after a ceasefire induced rally. Since the war began, the gold has lost 70% of its value. And here's why that it's so confusing that gold is supposed to go up when the world gets scary. Wars, inflations, market crash that the gold thesis is to be. Instead, when the Iran war hit in the February, gold sold off alongside everything else. But why? What's the exact reason? Because when markets panic, investors sell their most liquid assets first to raise the cash, and gold is universally known as most liquid asset. Morgan Stanley's core point is that gold near-term performance appears increasingly influenced by macro forces and largely institutional falls. Now, the second part of discussion is the contradictions in gold right now. So, here what makes the story genuinely confusing and worth your attentions. On one hand, gold said that Morgan Stanley would be cutting its second half 26 gold price target to $5,200 per ounce, substantially from a bullish of $5,700 per ounce, following a tough 6 week. On the other hand, Morgan Stanley's own CEO, Michael Wilson, is recommending a 60-20-20 portfolio. That means that 60% should be in equities, 20% in bonds, and 20% in gold, replacing half the traditional bond allocation with gold as more as resilient inflation hedge. So, same bank is simultaneously cutting its gold price and recommending investors that hold more gold than ever before. How is it possible? Because Morgan Stanley is making two separate arguments. The first is the gold's short-term price behavior is broken. It no longer reliably act as a safe haven during the acute crisis. Argument 2. Gold long-term structural role is stronger than ever for central banks for portfolio construction as an inflation hedge. Third part of discussion is the metal Morgan Stanley prefers right now. So if not gold, what would be that? Morgan Stanley named two metals with clear near-term bullish case. The first is silver. So silver is retreated from its early 26 highs, but the bank and industry data point to continued support from underlying supply demand dynamics. One of the main reasons is the persistence of the supply deficits over several years. Silver still appears to have a more tangible bullish case than gold because its outlook is supported not only by sentiment but by structural demand and the supply. We covered silver back in our week one of our series that solar panels, EVs, AI semiconductors, 5G, all massive industrial silver demand drives. The second metal they name is the aluminium. It's another metal where the Morgan Stanley thinks it's a clear bullish case. The reasoning is because aluminum is critical to EV manufacturing, aerospace, and AI, which, like silver, it's a commodity with real growing, measurable industrial demand rather than sentiment driven, which name as a safe haven flows. So two metals, real demand, structural supply deficits that the Morgan Stanley thesis. Now the main part of the discussion is the investment framework. We'll talk about gold, which is thing to be the still hold but manage expectations. Silver, the more compelling near-term trade, and structure supply deficits every year since 2021. What about aluminium, the underrated play, which could be said that the less retail coverage, direct exposure to EV manufacturing boom, and the ETF like iPath Series B, Bloomberg Aluminium, and will be giving the exposure to aluminium. So gold hit at $5,518 per ounce, crashed to 4,700 approx. Morgan Stanley cut its target, but still recommends 20% in portfolios. And their preferred metal right now are silver and aluminium. The safe haven thesis, it's not dead yet. It's just more complicated. And the metals with the clearest bullish case aren't the one everyone is talking about. We covered silver all the way back in week one Morgan Stanley just confirm what we said then. So subscribe so you don't miss in the future. Make sure to like the video, share it with your friends, family, colleagues too. Welcome to Money Brief. Let's rock together.